Today, my guest is Jonathan Twombly. Jonathan is a former Wall Street attorney turned real estate investor. He's the principal at Two Bridges Asset Management. He's also the host of the podcast Real Estate Launchpad. He's got a large following on Facebook with his Facebook group Multifamily Investment Community and also Real Estate Launchpad. Today, we're going to talk with Jonathan about why he sold all of his multifamily real estate. But first, couple of quick reminders. If you like the show, CREPN Radio, we would love to hear from you. You can like, share, and subscribe, and always leave a comment. Also want to remind you, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel, Commercial Real Estate Pro, Pro Network. With that, I want to welcome back my guest to CREPN Radio, Jonathan Twombly. Jonathan, how are you doing?
Hey, I'm great, Darren. Thanks for having me back on the show.
Yeah, I was looking through the episodes, and last time we talked, it was number 36, almost well over 2 years ago, and it's a long time. And I'm looking forward to talking to you again today. Before we get going, if you could just take a minute and share with the listeners a little bit about your background, and then we'll get into it.
Yeah, well, as you said, I originally started as a Wall Street lawyer. I was doing corporate litigation for a very long time. Corporate litigation is basically when you represent two big corporations that are fighting with each other over something. So typically I was representing these kind of, multi-million dollar, multi-billion dollar businesses fighting over hundreds of millions of dollars. Over time, that evolved into representing hotel owners when they were fighting with the chains whose flags they bear. And probably, I think one thing a lot of people don't realize is that when you go to a hotel, it's a Marriott, it's a Hyatt, or whatever it is. Usually it's not Marriott or Hyatt or what those other companies don't own that hotel. That's owned by some private investors, and it's flagged and managed by those chains. So there's a lot of disagreements that they get into over how the property is being managed, how it's performing. So we would represent owners exclusively in those contract disputes. As a result of that, I got very familiar with management contracts and kind of how these deals were structured, because I would see what happened when they fell apart. So I was kind of looking at them from the inside after the fact, But it was a real grind. That being a lawyer, as you might imagine, it was a lot of 14, 15-hour days, working on weekends, hardly seeing my family. And I was a bit frustrated by being a service provider. I really wanted to be a business owner. And, I'd always been interested in real estate. But in 2011, I was kind of a belated victim of the financial crisis, because the financial crisis was usually in recessions. We have a lot of litigation because people are looking for somebody to blame and collect from when the economy goes down. In the great financial crisis, it was so bad that people didn't even want to spend money on litigation. So we were waiting for this enormous wave of litigation to hit, and it never did. And finally, after a couple of years, my firm got tired of paying me like $300,000 to sit around surfing the internet. So they let me go, and I was done anyway. I was through with the business. So I started looking for other things to do. To make a very long story short, I wound up connecting with a woman who was starting up a real estate syndication business. I had no idea what that meant at the time, but I was looking for the next thing to do. I was in a position where I had some money saved up and I could do something new, start a business, take a risk. We started that. We got pretty far with a couple of deals. We had them under contract. We got them pretty close to closing. We had the funds lined up from investors, but we had banks back out at the last minute on a couple of deals. This is a very different environment than it is now, where people are throwing money at real estate left and right. It was still early in the cycle. It was right after the crash. Banks were very, very skittish and kind of looking for reasons not to do deals. So we wound up eating a lot of money in due diligence costs and stuff like that, and bank fees and whatnot. Really took it on the chin. And after that decided, maybe we should go our separate ways. And at that point, I thought I was going to have to go back into law. And one of my investors stepped in and said, "Hey, look, I believe in you. I know what you're doing. I'll back you in a multifamily business. And so that's how Two Bridges was born.
Got it. Got it. Well, the your background with the focus on contracts and stuff, I would guess, is a huge asset for multifamily real estate deals when looking at contracts and understanding the seller's position and all the provider contracts, and then all of the, like you do in syndication, all of the additional levels of contracts that are there. So I would guess that your talents and your training have given you a significant leg up compared to more of the people that are out there just like numbers kind of thing.
Well, I think definitely had an advantage in understanding how these relationships were structured, right? And how these partnerships are structured and how the participations work and the waterfalls and stuff like that. And, but I have to say, people, I see something that frustrates me very much in the kind of, the space of real estate where you and I are both operating, where a lot of people are doing it on their own, or they're small operators like me. A lot of people want to skimp. They're looking for ways to save money, and one place where they're going to skimp, I know you know this from the insurance business, they want to skimp on insurance. They also want to skimp on legal fees. And even though I'm not a lawyer, I haven't practiced law in a very long time. I hope I never have to do that again. And I avoid doing legal work myself if I possibly can. I always want to hire the right lawyer for the right job because it's so important. So people ask me all the time, oh, hey, aren't you lucky because you can do the legal work yourself? And what I say to them is, I can't. I wasn't that kind of lawyer. I looked at the contracts after they fell apart, but I wasn't involved in drafting them. I understand how they work, but I couldn't recreate that myself. I can't do the syndication documents. I wasn't an SEC lawyer. So, I wasn't a real estate lawyer. So I hire the right person, even though I probably have a leg up on, I could figure it out better than the average person because of my background. If I had to, I would just never do that. You really have to hire the right person.
And I didn't mean to imply that you can be the jack of all trades and do it all yourself, kind of a DIY investor, as much as I think just the nature of a large real estate deal is the degrees of complication when you really get into it. And I think what you were alluded to about the details, the details in a contract, whether it's a real estate contract or a insurance contract, as they say, the devil's in the details. And if you just kind of just whatever, I just need that, just sign it kind of thing, you can find yourself in a world of hurt and
absolutely.
And so I think that's kind of more of what I was I guess what I was inferring, and what I meant by that was that, and I find it just, especially with insurance, I don't want to go down the insurance rabbit hole here, but it's a grudge purchase. Nobody's excited about buying insurance. But if you don't understand what you're buying, you can end up with nothing that represents what you thought you were buying, and be in a world of hurt when you have a claim or whatever. So
I think it's the same with real estate. I mean, if you hire the wrong lawyer, with legal fees and legal stuff, if you hire the wrong lawyer, you can wind up in a lot of trouble. So if you hire your brother-in-law who has done some house closings, and says, oh yeah, I know, I can figure out how to do a commercial purchase, like, you're going to wind up, in a world of hurt with that person because he doesn't have the right expertise. But, in terms of like how my background helped me, though, it helped me in a way that I didn't expect. Like, I expected it to help me with understanding the contracts and understanding the partnerships, where I found myself being surprised by how my background helped me was actually in like client service. Because, being a lawyer is a very client-focused business, and you have a fiduciary responsibility to your clients, and you really are legally and ethically obligated to put your client's interest ahead of your own. And that's really what you also have to do as a syndication sponsor. So I found that, I already had a really good sense of like how you treat clients, how you keep them informed, how you, when something bad happens, you let them know immediately, just the whole client management process, that managing their expectations properly, all of that I found to be very helpful. And actually, ironically enough, I found marketing like just sort of putting together my marketing documents for deals. I had done some marketing in the law firm I worked at to just market the practice group that I worked in. And that experience came in very, very handy in terms of putting together documents. And then the final thing I'll say is sort of being persuasive. Like as a litigator in particular, your whole job at the end of the day is really to convince somebody else of your position. And so I found that I'm pretty good at marketing persuasively because I spent 12 years of my life learning how to be persuasive. So, and I'm not talking about in like a really ham-fisted or like twist your arm kind of way, but just like telling the tale in a way that makes it appealing.
No, I think there's tremendous value in that. I think that it's really easy to get caught up in the numbers, but if you don't have the story that compels people to want to invest or want to join or participate, it doesn't matter how good the numbers are. And I think that just, especially in the marketing, especially all that you've done with your efforts online, and that I applaud you because I think you do a tremendous job. And I always enjoy reading whatever you're posting because I know you've put a lot of thought into it, and that I know that when you put something out there, it's a connected thought. It's got a beginning, a premise. It's got some arguments that support it, and I always find it must read kind of stuff if I find your stuff online there. So hats off to you for that, and I think it is serving you well, and I think it will continue to serve you well. And I think the art of storytelling and creating a compelling argument is something I don't think that everybody fully understands.
I appreciate that. I have to say, in today's market, there's not a lot of storytelling that needs to happen. I think you pretty much have to say, hey, look over there. There's a building. It has a roof and four walls. It's going to be a great deal. And people say, okay, here's my money. So some of the stuff we'll probably talk about a little bit later. We'll touch on that, but that's where we are in the market right now. So I don't think storytelling is as important as it was, and as it will be again when we're in more of a down cycle.
Yeah, when the tragedy is also, tragedy is a type of storytelling. So let's just shift gears here for kind of get us on track here. Before we talk about all the reasons why you sold your multifamily, I'd like to start at what attracted you to multifamily. You mentioned your kind of Wall Street experience and understanding contracts and working with hotels and that. What was it that attracted you to the multifamily real estate?
So, you have to remember, as I said, I got into the business pretty soon after the Great Recession. It was 2011 when I first started. So the memory of that was very fresh in my mind. And, thinking about the different kinds of real estate that was out there, it was sort of multifamily was almost by process of elimination. I looked around at retail. Well, businesses go out of business in a recession. And that was even before now, where we've got Amazon. I mean, Amazon wasn't even really a thing. It existed, but it hadn't taken over the world yet in 2011. Hotels, I mean, I was in the hotel business. Hotels got crushed in the recession because people cut out all that discretionary travel, and even businesses cut out business travel. They started using, the predecessors to Zoom and stuff to hold meetings instead. Industrial, the same thing. You had businesses going out of business. So you kind of were, when you looked at all the major food groups, office, same thing. Businesses were disappearing. So the only thing that wasn't disappearing was people. People still had to live somewhere. And, it seemed to me, looking at things at the time, that the further down, well, to a certain extent, that within multifamily, within rentals, multifamily looked good because it was big enough to make money on. I was trying to do this professionally and make a living off it, not sort of invest some money on the side. So I needed to have some scale. I couldn't just invest in some duplexes or something that wouldn't have been enough money. I'd actually been down that road analytically and figured out that it wouldn't work before I was let go from my job. And so multifamily had scale. Then within multifamily, I tried to think about, well, we just had this big crash. Real estate prices for houses have gotten really cheap. Who's buying those houses? It's people who have money, who can't buy houses right now. It's people who don't have the wherewithal for a down payment and stuff. So people who have to rent. So who has to rent? So you kind of went down the scale. So I wound up looking at kind of B and C multifamily from the two perspectives of people don't disappear in a recession. They have to live somewhere. And then, who is it that has to rent? And that was really the analysis that I went through to arrive at why of all the different things I could do, why multifamily in particular.
Got it. And so when you got in to a property, you basically, I mean, from a justification for the market, it was just basically supply and demand, and that people weren't going to go away. Is that kind of what that was?
Yeah. I mean, I really,
a place to sleep.
I have a real, I'm very conservative in terms of investing, and I have a real sort of value investor mindset. And the fundamental thing that makes you a value investor as opposed to other kinds of investors is that you're thinking about the downside as much as the upside. You're really, I think in the long run, the way you make money is by not losing money. I think like Warren Buffett has a thing, like, here are the 2 rules of investing, rule 1, don't lose money. Rule 2, see rule 1, and so from that perspective, I was really looking at defensively, if we have another recession, what's going to happen? Like, how can I be safe if another recession comes? So I wasn't in that mindset of like, how much money can I make? Of course I wanted to make money, but I thought if I could focus on not losing money, then almost by default, I would make money. And multifamily
Right.
seemed to fit that bill very well because of what I just described a moment ago about people not disappearing in a recession.
Got it. So you put together, was it a syndication then that you ended up, you mentioned your initial partner that you guys parted ways, but then you ended up eventually buying some multifamily. How did you go about doing that?
So with the original partner, we had been looking at deals in Louisiana and Texas. And I actually had some friends who had already sort of lined up and said, hey, if you go into business, I will give you money to invest. And it was quite substantial. So we had that money lined up. I then sort of had to discover through the process of like, oh, if you have investor money and you're buying real estate and then you're participating and they're just passive, what is this structure? Oh, this is a syndication, right? So I had known from my lawyer days about private placements a little bit. I'd seen these documents before. I just didn't, they were never referred to as syndication deals in my world before, but I had seen, PPMs and sort of seen these structures before. So I kind of, okay, now I see what's going on here. So we did structure those first couple of deals that we didn't get closed as syndications where we would have used, if we had closed, we would have used the money from my friends who were going to fund these deals. Once we split up that partnership and I went into business on my own, that money was still available to me, fortunately. And none of that money had been at risk. So the money that we lost was all of our own money. And I think that actually made an impression on the investors that I had never put a dime of their money at risk. And I never went and told them like, hey guys, like I lost all this money trying to do this deal for you. Like, I just felt like you don't say stuff like that. I took the risk. It's on me. So, but I think that they were watching the process and saw that we were getting ready to fund the deal and we didn't close, but they never had any money at risk. It never cost them anything. So when I formed my own business and then started looking at different markets and finally found a deal to do, they were ready to go. They still had the money there and it was all set. So.
Okay, got it. So let's talk about the properties that you did end up buying, and maybe part of your experience on the operation from acquisition and what did they trend up, rent. Tell us a little bit about what you bought and how the investment worked.
Yeah, so I'll talk really in the most detail about the first deal that we did because I think it's the one that I learned the most from. Wasn't the best performing deal, but it's the one that taught me the most. So I found this property. It was in South Carolina, And it, compared to the stuff I'd been looking at in Louisiana, this place looked like a palace. We had been looking at really some C minus, C minus minus stuff in Louisiana. It was pretty rough. Cash flowed really well, but we never got far enough into it because we never closed to find out probably all of the deferred maintenance surprises that we didn't get to find out about because of the age of the property and the condition. But I found this property in South Carolina. Was very, very lucky. I got an introduction to some top-notch brokers in South Carolina, and went down to meet them. And literally, they said, "We got this deal in here 2 days ago. We haven't shown it to anybody. Why don't you go take a look?" So I did. I drove out to the property, looked around. It looked so much better than the one that there was stuff I'd been looking at in South Carolina. Sorry, in Louisiana. That I thought, okay, I want to make a bid on this property. We looked at the financials, put a bid together. And I think maybe the brokers might have come back once and said, "Can you sweeten it a little bit?" So we did just a hair, and then they convinced the seller to take the deal. It was a fix and flip situation. So the seller had only held the property for a year. So they were making a pretty fast profit. So we got the deal done. That was great. Woohoo, closed the deal. I'm a real estate investor for real now, all that kind of stuff. But the problem started almost immediately. And they started on things that I didn't expect, never had any reason to think that these would be issues, because they're the kind of things that, never talked about in the books and the courses and the other things that you study when you start out. So the first thing that happened was I brought in a management company that wasn't local to the area because I already had a relationship with them. I'd met them trying to find a management company for this deal in Louisiana. They were throughout the Southeast. They were very big. I thought, okay, well, this is great. They had a presence nearby, but they didn't have a presence in that market. And they were very eager to break into that new market. So the first thing that happened was they put in because they weren't local, they had a lot of trouble finding a manager to run this property. And they were running it with like temps. They were bringing in people from outside for several months because they just couldn't hire somebody to run the property. And when they finally did, they hired somebody whose background was in subsidized housing, right? And they assured me it's going to be fine. We'll train her. She knows what she's doing. But it wasn't fine. Turned out that, in subsidized housing, there's so little of it. It's in such high demand. Subsidized housing usually has waiting lists. So to market a property, basically the marketing for that kind of property is you call up person 1 on the waiting list and say, "Hey, there's a vacancy. Get down here before I call person number 2 on the waiting list." And they drop whatever they're doing and they run down to rent the apartment. That's a little different with market rate property where you got to get out and actually market it, right? So this manager never got out from behind her desk. And before long, we had 85% occupancy in a market that was 95% occupied. So that was, sort of disaster number 1.
Yeah, I'm assuming you can feel that too on the bottom line, 10%. I mean, that's pretty big.
Oh, I mean, it's horrendous. It means that you're not making any money at all. Like you're barely making your debt service, right? And then the next thing that happened was, so we had all this vacancy, and vacancy, when you have vacancy problems, it can become really, like, things can spiral out of control very, very fast, because suddenly you have a lot of apartments to turn. Obviously you don't want to turn them all because that's expensive. You want to turn them as people are renting, but you don't have the cash to turn them. You start having to put more money into the property to turn them. And if you don't have the money to put them into the property, like if you don't have that cash available, then you can wind up with a situation where you can't get stuff rent ready when people are coming in, and your cash flow just starts like spiraling and spiraling down. So we had that problem to contend with. We started having to put money into the property. And then the next thing that happened was, because that we had all this vacancy on the property and it was summertime and the manager never got out from behind her desk, we had 3 apartments where I don't remember exactly what happened, whether the HVAC units broke or they were leaking or something, but 3 apartments became completely infested with black mold and they had to be taken down to the studs and
Oh
redone.
boy.
This was like a $25,000 expense. So we had that happen. We had to put more money in at that time. And you know, another sort of rookie mistake I made in connection with that was I didn't want to make an insurance claim because I was afraid of my insurance rates going through the roof if I made a claim. So I wanted to just try to finance it out of cash flow. That turned out to be a big mistake. I really should have just financed it from insurance proceeds and taken the small hit for that claim. But, you know, we didn't make a claim. I think the management company might have even said, like, don't make a claim because your insurance rates are going to go through the roof. So we didn't. But those apartments, even as we fixed our occupancy problem, those units were offline for years because we just never had the cash to do it until we just finally just put the cash in from, you know, outside the deal.
No, that's a lesson. I think, you know, being in insurance, I think I'm kind of sensitive to it as well. But the reality is, if there's coverage, and that's why you buy the policy. I mean, you don't. I mean, obviously, if you can manage it as a business expense, I think in the long run you may be better off. You know, and obviously your loss experience would always come back to you know, affect your rates and potentially your the opportunity to get a competitively priced insurance policy. But I've been there and I've had these conversations, and that can be painful. But I always tell people, hey, if you can't, the policy will respond as it will. Mold is always kind of a tricky thing, just based on, there's a lot of exclusions based on mold. But if the cause of the loss was something that was covered, then there would be coverage for that. So, but anyway, oh, go ahead.
Go ahead.
No, I was just gonna. So you talked about. It sounds like, you know, you celebrated, you had the deal, then the issue started to evidence, and it sounds like it started with management. Is that kind of the? I mean, when you know, you peel back all of the issues, is the one common thread? Is it the management and their ability to manage?
There were two things. There was a management company, and then there was my inexperience as an operator, right?
Sure.
So
Sure.
I didn't know how to push the right buttons and be threatening enough to get them to take action. Now, finally I did. I finally threatened to fire them, and, you know, they made this big show of the CEO of the company flying in from Memphis to visit and, you know, to get things back on track. And they assigned, you know, a new regional manager in addition to, you know, firing the manager and putting in a new on-site manager. You know, we slowly got the property back fully occupied, you know, but then we encountered another problem, which was that we just, even after going through the rent roll, you know, for a year, we'd cycled through, there were no more, you know, I guess not no more original tenants, but we had gone through the rent roll once, renewals, so that everybody who, you know, was a problem tenant was supposedly off the property now and had been replaced with our own tenants. We had this persistent bad debt problem where we just had tenants just not paying their rent. So we had really high evictions, and we couldn't figure out what was going on because, you know, they had supposedly been raising the standards for new tenants, you know, raising the credit requirements and stuff like that. And still we had this persistent problem. So we weren't making any money because we had so much bad debt on the property. And it took us a really long time to figure out what the problem was. But apparently when they went to the vendor that sets, you know, where you set your tenant application requirements through a third-party vendor, right? And when they went to that vendor to set the requirements, either the management company or the vendor, I still don't know who, set them incorrectly. So rather than setting them for market rate, you know, conventional C property, they set them for subsidized housing, which means that rather than the normal, like 3 times, you know, you need an income of 3 times rent for conventional, they were only requiring people to have 2 times the income, which meant that they really couldn't afford these apartments, right? But the management company thought it was set correctly, so they never looked into that as a problem. They just couldn't figure out why all these people were coming back as approved, and then they were defaulting like right away. And so it took us maybe a year. And now this is when I teach my students, this is one of the checklist things. Like, if you are having a problem with bad debt, look at this issue, right? As to whether the standards are set correctly by this vendor. But it took them a year, it took the management company a year to figure this out. And then guess what happened? So they went to the vendor and they figured out the problem, said, you have to reset this to the market rate, right? Market rate tenants. And the vendor, instead of doing that, went and reset all of our properties. We had acquired more properties at this point, reset all of our properties to affordable.
Whoa.
So we started having this problem everywhere.
Everywhere. Whoa. Going in the wrong direction there.
Yeah. So then we started seeing, at properties that were strong, that were performing well, suddenly bad debt was ticking up there too. And then we got to the bottom of that pretty quickly, but that was, it took a while for us to figure that one out as well. So
I am so glad you've shared that with us, because I think that again, when you're trying to fog a mirror, fill a unit, the temptation can be to, you've got an applicant, you've got everything looks good, but if you don't understand that one critical thing, the multiple of rent to their income, you can really set yourself up for some challenges. And 3 times is, I think, just as a great safety measure. I mean, at least you're not going to be chasing them like you would if it's 2 or less.
Yeah.
So,
I mean, if it's two or less, I mean, literally, if you think about someplace like this is kind of suburban South Carolina, you can't get anywhere without a car in this market.
Right.
No car means no job. So people have a car payment on top of their rent, and not to cast aspersions, but I mean, honestly, like, if you're dealing with C-class tenant, for the most part, these are not people who have like a high degree of financial sophistication. So they may be buying like the car that they can afford because they go to the car dealership and the car dealership wants to sell them the most expensive car possible. So they'll look at their credit and they'll look at everything and they'll say, this is what you can afford, just looking at the car, but they're not looking at their car and their rent together. And the same thing with like on the rent side, the rental standards are not taking into account like their other indebtedness, right?
Right.
So you're just looking at, well, they've got, 3 times, their income is 3 times the rent, but you can't also see, but their car payment is also 1/3 of their income too. So they've only got 1/3 left over. And if you go down to half, right, people just can't pay both. So that's where you go. So I always tell people, when you're doing due diligence, this should be an item on your due diligence list. Show me the current credit qualification standards that are in place at this property, so you can review it and make sure that either it's okay, or if it's not okay, then you've got a tenant credit problem, and either you're going to retrade the deal or walk away from the deal, or put a plan into place for when you take over to as quickly as possible deal with this tenant credit issue.
No, those are some real words of wisdom there. So you got, I mean, I'm assuming this righted itself once you identified it and you were able to correct it from affordable to market rate. Did that correct itself then?
Well, so then the answer is no. We still did. We still had problems. Okay. This is the nightmare that never stops, giving, right? So so we ran into an issue with the lender at this point, because we were not collecting enough rent, and we started running into an issue with our debt service coverage ratio. We weren't covering it adequately. And so we got put into what's called cash management, which is where basically, the way a lot of these deals are structured is when the tenants pay rent, it goes temporarily into a sort of a holding account that the bank holds. And then if everything is fine with your property, it just automatically gets swept into your operating account. But the reason that temporary account is there is so that if something happens, like you go into cash management, the lender can just slam that door shut and keep the money to make sure that your debt service is getting paid and all your escrows are getting paid. And then only give you what's in your operating budget, right? That's all you get until you fix the situation. It's really, to my mind, very backwards because of, it's also a way to put a property quickly into a situation that it can't recover from because it now is starved of money. But from the bank's perspective, they've decided that this is safer, that they get the money first. And so we got into a cash management situation. We got ourselves out of it ultimately, but as I didn't find out until long after I had fired this management company and replaced them with somebody else, part of the way that we got our debt service coverage ratio issue fixed, unbeknownst to me, was that the management company was getting bills from vendors and just sticking them in a drawer, and they weren't hitting the financials. So they weren't getting paid. They weren't hitting the books. And we kept on getting, I was getting vendor calls here in my office saying, why haven't we been paid? And I talked to the manager, and the manager would say, I submitted the bill for payment. I don't know what's going on. And, even after, for years after, we were getting vendors coming out of the woodwork saying, hey, I never got paid for that thing a year ago. And the new management company finally figured out that the bills just hadn't gotten submitted at all because they could never find any record of them. So that was how we solved our debt service coverage ratio issue, by just not paying bills and not reflecting in the books. So this is like, so what happened was then we finally got so new management company comes in, we get the tenant profile correct. We start working down the bad debt. All this bad debt has to be written off the books. It wasn't, it had been just accumulating on the books. They weren't writing it off property. So we had to write off all this bad debt. We had to get the right tenants in there. But then we still had this problem of all these back payables that had to be paid off, and just had to work down that payables issue. So that really took a very, very long time to catch up, a couple of years as you're running the property, but you've got all your excess cash going into paying back payables. You're obviously not making any distributions to your investors. You're not making any distributions to yourself, right? You're just running this property for free. But so that's sort of where we were. Now, what I want to say though is that this does have a happy ending.
Yeah, I was going to say that the topic of why you sold all your properties, I mean, so far it's like, why did you keep them at all? Kind of thing. So, but no, and I say it in jest. I want to hear how. So you've got the new management in place, and take us through the new management and the debt and all that.
Yeah. So the new management was a local management company, very well respected. They had actually managed this property before. They were very familiar with it. They knew the market very well. They were, had better relationships with local vendors. They were able to get people to stretch their terms a little bit as they got things straightened out. I think probably a lot of the local vendors felt more comfortable when this new company came in because they were known in the market. They were, a very reputable business, a very reputable company with a, really long operating history and a good reputation. So that sort of bought us some leeway with the vendors. And, this company actually obviously knew like how to manage this property better, started, slowly raising the tenant credit requirements so that we were getting better quality tenants in there. But they were dealt a bad hand, right? I mean, they walked into a situation that was bad and they had to fix it. And they did a really, admirable job of slowly clawing out of the hole that they stepped into when they took on the property. So, meanwhile, the other properties were doing, various ranges of better, from better to much, 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 much better, sort of spectacular, off the charts good. But this one property was just the thorn in my side. And, it does have a happy ending, but there's a few more chapters of misery that we still have to get to. I mean, this really is like, I'm going to write this up as a case study someday.
Yeah, say this is the crash course in how to manage or how to acquire, manage, operate multifamily.
So new management company is on site for, let me figure this out, about a year, no, maybe 6 months. And one morning the manager calls me on my cell phone, and he says, Jonathan, I hate to tell you this, but we've had a fire at the property. And we lost 3 units, out of 102 units. This time, it was insured, obviously, and we got that. We have a great insurance broker, and we got all that stuff moving very quickly. But so we had that to deal with on this property that already wasn't performing very well. Fortunately, we had all the right kind of insurance. We had lost profits insurance. We had, we were covered up and down for this. But we now had to deal with rebuilding those 3 units, and literally not a month passed when I got another call from the manager saying, "Jonathan, I can't believe I have to tell you this, but we've had another fire." Actually, he was calling me from the fire. Like the fire was raging behind him.
Wow.
As he called me, and he sent me pictures of so we lost a whole building. And the fire, in both cases, the fire was so bad and so hot that the fire marshals they weren't able to tell us what the issue was, how the fire started. My suspicion, given when they both happened in the morning, I think that somebody just turned their stove on to make breakfast and then left the house and had a fire that way, because it was right around 8:30 in the morning both times. But now we lost a whole building, and that now had to be rebuilt. And because it was, a whole building, it had to be brought up to code. And, so that then, started a basically year-long process of having to rebuild now 9 units from 2 separate fires, have our insurance terminated, and having to find new insurance at a much higher rate. We had to pay through the nose for the insurance because we had to get construction insurance on top of it while the construction crews were there. So it was just another nightmare. So this is basically the property of all the properties we owned. I didn't really have to give much thought to the other properties. This is the property that, every time I got a phone call from my management company, it's like, what else, what could it be now? And it was, just a nightmare. Everything that could have gone wrong with this property did.
Well, it sounds like you've been through it, though.
Yes.
I mean, and I would say that while nobody wants to learn all these lessons because there's a lot of pain in them, you've certainly learned the cause of the pain and what to look for to avoid the pain. The fires are fires, but I mean, all of these things we talked about with the management. I mean, that's just amazing.
I mean, even with the fires, there's learning there too. You probably know about these things from your business, but you can buy these canister things that you put over the stove. They're super ugly and tenants hate them. But basically, if a fire starts in the stove, when it gets hot, when they read the temperature, just poof, they drop all this powder on the stove and put the fire out. We installed those at all the properties after that to avoid these stove issues again.
Yeah, and while they'd put out like a cooking fire,
Right.
if the burner was just on and there was, if there's no, I don't know how it would work with something that's electrical kind of thing. I think it's typically more like a, pot with food in it that's caught fire. But nonetheless, I do know of what you speak, and I know that companies will provide a credit for putting those in place, and they're good.
When I talk about, sorry to interrupt you, but when I know where you're going with this learning thing, like I often tell people, if all of my properties had done really well, then I would be sitting right now sort of patting myself on the back going, boy, am I smart? Like, I'm such a great investor. Everything does really well, and I'm just super. And I would have learned like 10% of what I've learned because of my experience with this one particular property. It's completely changed my approach to how I would underwrite properties, how I would, do my due diligence on them, how I'd approach them, how I would approach the takeover of the property, really sort of everything. And I feel like it's made me a much better, stronger investor because I've been through this experience. And, to the extent that I'm teaching other people how to do this, it's made me a much better teacher too, because I have just so many more things I can show them through experience to look out for that they just really may not be expecting. Because like when I got into the business myself as a new investor, I just had no, like all of these things took me by surprise because I just had no experience with them, and and nobody writes about this stuff. Nobody talks about these things that come up. They just talk about how great multifamily is and how you can make money and here's how you do a deal. But sort of, these courses all stop when you close. It's like, okay, now you're all set for life. You close the deal, you're going to be rich now and good luck to you. And, it doesn't end there. That's the easy part, is getting the deals. I hate to tell you that all these people out there struggling to get deals, you think this is the hard part. That's not the hard part. The hard part is managing these deals successfully. That's where you really make your money. You have to do that right.
No, absolutely. So let's bring this forward here. So you righted these things. You got these units. I assume you got them reconstructed, got them rented. Where are we on the path of this property? And I guess maybe the question is, how long did you actually hold this property in South Carolina?
So we, along with everything else, we sold everything in February, so a little over a month ago. And the happy ending of this property is that because of where the market is and because of where it was when we bought the property, we did really well on the sale of this property. So despite the fact that we didn't pay investor distributions for a long time, that the property created all kinds of headaches for us, we sold it at such a nice price that our investor was very, very happy with the end proceeds. We made some money. We paid back all the arrears on our preferred returns. We paid back ourselves for all of the management fees that we didn't take. And we still are able to distribute money to ourselves after paying the investor, what they're entitled to get. So all's well that ends well. But what I tell people is a couple of things. One is, this doesn't happen to you if you don't have the wind at your back. And what I mean is, in a rising market, you can make a lot of mistakes and still make money. And that's really what happened to us. I mean, I'll be the first to admit that the market is what saved us. We bought at the right time and we sold at the right time, and that covered up for a lot of bad stuff that happened along the way. If you were buying today, where prices are at all-time highs, and you had half of the stuff happen to you that happened to me, you're going to be in a world of hurt, because first of all, you probably won't even make your debt service if you're paying the kind of premiums that you're making. So you're going to be looking at foreclosure, or at the very least, if you're a sponsor, you're probably looking at being removed by the bank and your investors and just kicked out of the deal. But you could be looking at foreclosure, and the market's not going to save you. Like the market, there's only one way for the market to go right now, and that's down. If you're lucky, the market will just continue to kind of hold on where it is at these all-time high prices for a while, but probably not for 5 more years. You're probably looking at a situation where cap rates are going to rise. I mean, if I were a betting man and you asked me to take a bet, is the market going to stay the way it is for 5 years, or are cap rates going to rise? I would take that bet all day long. The cap rates are going to rise from here. They just don't stay like this forever. So if you are getting into kind of like a marginal deal and you're not really a strong operator, and you had something like this happen to you and you're inexperienced, this is really a recipe for disaster. And I'd also say, to passive investors, look at who you're getting into bed with in these deals, because this is the fate that potentially awaits you. And, in a situation like where we are now, we're not talking about having a happy ending if you wait long enough. We're talking about you losing your entire investment to foreclosure if things really go wrong, if you're buying at the top. So, please be careful when you're considering investing in deals like this.
Yeah, and I think that everything you're saying, I have my concerns, and I recognize that. I think there's a distinction between the asset class, meaning A, B, or C properties, that I don't think's being accounted for on a lot of these. I think a lot of what I'm seeing is that there's a market cap rate for multifamily that people are paying attention to, as opposed to a cap rate for the specific class of asset you're buying, taking into consideration some of the, and we didn't talk anything about any kind of, you know, deferred maintenance or any kind of, you know,
Oh yeah, that
capital
was a whole
expenses.
other thing that came up that we didn't even talk about, but you can just imagine there was a lot of that too, a lot of unexpected expense.
Yeah, and I think that's as the market's frothy and looking for deals. Um, I think there's a lot of opportunity to buy a property in need of a lot of capital expenses, and if you're not properly accounting for that, you're going to be rudely awoken. Um,
I mean, I'll say this, like the strategy that we employed for this property was not a repositioning. I mean, we were just going to buy and hold it and just run it, sort of maintain it the way it was, and just do a management value add play. This is sort of like we bought it from a flipper. They weren't an operator. They left a lot of meat on the table for us, and we were just going to raise rents, and we did. We got a lot of rent growth, right? But we got a tremendous amount of rent growth, but just the expenses, we just could never catch up with the expenses. But if you're going in now with like a true value add play where you're getting rid of all the existing tenants so that their credit is not an issue, you're fixing all the deferred maintenance, so that's not an issue, right? And you're raising rents a lot, so hopefully you're going to fix your DSCR problem. If you're going in with that kind of strategy, you might be able to make it work, but the risk there is that there's a couple of risks. One is that if you're a passive investor, you're getting into bed with an investor who doesn't know what they're doing, right? And they've underwritten the deal, so everything has to work perfectly, or it's not going to work out. So that's one risk. But another risk is that the market shifts against you while you're doing this value add. Where we're in a position right now where people are paying premiums for properties because the economy is strong and the expectations are good. These things, when they change, they happen to change very fast and people don't see them coming. So you've really got to be sure that you're going to get this value add program finished, and then you're going to get the property stabilized after that. So you've got really like 2 years of a process that you have to go through before you're going to really be stabilized. And then you hope that you don't run into some economic issue with rising vacancy at that point. So there's still a lot of risk. I'd say there are things that you can do to try to minimize the risk as compared to what we did. Putting CapEx and stuff into the property is one thing, but you just have to recognize that you're then taking on a different kind of risk if you're then engaging in a big capital program.
Right. Jonathan, I want to shift gears here a little bit. As I mentioned before we started recording, by day I'm an insurance broker, and we manage risk is what we try and do. And there's a couple strategies that we employ. Typically avoid the risk, minimize the risk, or transfer the risk, which is essentially what an insurance policy is. I'm asking all of my guests if they could take a look and provide us some input on what they see. And I ask you what you see as the biggest risk you face or investors face today. And I'm not necessarily looking for like an insurance related, risk example here, but if you could identify and speak to what you see as the biggest risk that investors face.
So I think the biggest risk, and this is a big part of why we sold the properties actually, I think the biggest risk that investors face is actually the economy. And that's going to sound very strange given that we've got, the best unemployment rate in 50 years and the economy is chugging along pretty quickly. That's precisely the time at which the economy becomes a risk. The economy is not a risk after a crash. After a crash, all the risk is out of the economy. That's when growth starts, right? Again. And so you're stepping into things as they're on an upswing. When you're at the top, the only place to go is down. I think a lot of people are hoping that we're somehow magically going to stay at this, at the height of the economy for the indefinite future. And that kind of hope is getting priced into deals. So people are pricing in, high employment. They're pricing in record high occupancies. Right? They're pricing in rent growth that may or may not happen, but it all really depends on continued economic growth at the pace that we have it right now. So people are paying a premium for properties based on economic news, which honestly, if you look at history, cannot sustain itself. And it can't sustain itself for very much longer. And, when, for instance, when employment reaches a peak is when it starts going down. Like, that's sort of basic economics. If you follow the economic, analysis, that's a lot of people writing right now. I mean, that's pretty standard. A lot of people are trying to figure out when this next recession is going to come. They're spending a lot of energy doing it, and they're bad at predicting it. But I think everybody knows that something is coming. But in multifamily world, I feel like a lot of people are really turning a blind eye to it, or they're kind of giving some lip service to the fact that an economic downturn is going to happen in the not too distant future, but they're not really adequately planning for this risk, right? So, so I think that is the biggest risk. And I think another big risk, and it's related, is and this relates to a big reason why we sold, if you're dealing with C properties, the tenant class in C properties, this is also often referred to as the renter by necessity class. There are people who, they've got jobs, they can pay the rent, this is market rent territory, but in an economic downturn, they will be hurt the worst. They always are. In the last downturn, we had, I think, 11% unemployment at the peak. But if you look at people with a 4-year college education, their unemployment rate peaked at about 3%, which means that for everybody else, it was much higher, right? And the further down, and literally, the charts will show you, by education, the less education somebody had, the higher the unemployment rate was. So if you're owning a property or looking at properties that are C-class properties, you're taking a big, big risk that when the recession comes, you're going to have a lot higher vacancy, right? And there's another mythology around multifamily investing, which is that rentals do well in recessions, right? And that mythology comes from two things. One is that multifamily does better than other asset classes in recessions. It's more resilient for the reasons we talked about before, because people don't go out of business, right? So it does better. But I mean, by better, if you look at the last crash, multifamily, I think, fell in value by only 32%. It was the best performer of all the asset classes because it fell by only 32% in the last crash, right? So which means the others did much worse, right? So because of that, people have conflated that. And then also after the last crash, when we had the foreclosure crisis, then a lot of people moved into multifamily who had been owning before. So occupancy really shot up. But they've also conflated that with the recession. That didn't happen during the recession. It happened after the recession. But times were still bad, so they still think of it as the recession, but it wasn't. So when people say multifamily does well in a recession, if they're buying based on that assumption, they're really making a big mistake, because it just emphatically does not do well in a recession. It just does less bad than other asset classes do.
Right. No, and that's an excellent point. I think the less bad is something that you don't hear about because everything got hit in the recession. And I think the other thing that I keep trying to gauge and look for some clues or some sort of a historical perspective on is, the depths of the recession that we had was not an average one. I mean, this was historic. So, recessions are kind of part of the cycle. The question I continue to ask and continue to look for some sort of a clue to is, how bad will the next one be? I think that, there are some people who believe it will be as bad or worse, than the last one. I find that hard to believe based on all of the economic stopgaps that have been put in place and the challenge with lending and all that. But I think that to ignore the fact that recessions happen and that they are part of the cycle, and and the fact that multifamily has historically done better than other assets is all good. But the fact is, it gets hit.
Yeah, and I think the real problem is that even if the next recession is relatively mild, and the impact on multifamily is mild, if you're buying at a premium, if you're essentially overpaying, then you don't have any room for a mild recession.
Right.
You don't have any room for any error until you figure out a way to really get your your rent's higher, and so you build in that NOI cushion so that when you suffer some occupancy loss, you still have enough of a cushion that you're not down below what you need to do to service your debt. And I think a lot of people are buying at such a premium right now, at such low cap rates, that, you know, they're hoping that they can get their value add done in time and re-tenant at higher rent. So they build in that cushion. But, you know, that's, again, you're taking the risk that you can't finish. You're taking the risk that something comes up, and you're taking the risk that the economy takes a big turn, downturn before you expect it. There's a lot of risks involved in that. So just want people to be conscious of these things. People always ask me, you're saying, Jonathan, don't invest. No, I would never say don't invest. Like, if you find a good deal, you should buy it. But what I really want people to do is go in with their eyes open and understand what the risks really are, and don't look at multifamily properties as if there's some kind of like ATM machine that is just you stick in a card and it's going to spit out money, right? It's an operating business, has a lot of moving parts. You have to have competent people running these properties, and timing is important. Like, you gotta, things have to be, the wind's got to be at your back to really make money. If the wind's in your face, it becomes much harder.
No, well said. Jonathan, I could talk about this all day. Always appreciate your insight and your input here. But before we wrap up, where can the listeners go if they would like to learn more and connect with you?
So if I have a toolkit that I give away to people on my podcast website. The website is www.realestatelaunchpad.net. It's not .com, it's .net. And if you go to realestatelaunchpad.net/booster, you can find what I call my 3-stage booster rocket. It is a toolkit of resources for you, one of which is a quick and dirty deal analyzer, which allows you to figure out really quickly whether you want to go deeper with a deal or not. Another is an ebook about how to set yourself up so that brokers pay attention to you even when you're new, so you can get good deals from brokers right away. And then there are about 11 or 12 videos that you can download for free on all kinds of topics related to multifamily investing. So realestatelaunchpad.net/booster. And if you want to get in touch with me directly, you can email me at jonathan@multifamilylaunchpad.com.
Got it. Jonathan, I can't say thanks enough for taking the time. I've enjoyed it and learned a lot. I think anybody who's listened to all of this has definitely learned a lot. And I look forward to when we can do it again.
Well, thanks for having me on the show, Darren. It's always a pleasure to talk to you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.